again. So that pretty much, because of my history and my training, that pretty much makes me agnostic about asset classes. I'm much more interested in the macroeconomic landscape, and that would dictate which asset classes I need to concentrate on. Coming out the GFC, obviously, considering the extreme interventionist policies of our governments, particularly the American and the West, they pushed us all into stocks and property markets. But what they did, those policies and those massive interventionist policies instigated a debt growth, which I was very clearly studying. The cancer of the system is the global debt structure. I spent a great deal of time studying global debt structures, but rather than demonstrate a global debt structure, I thought I'd give you Bridgewater's latest piece on what they're looking at. They're very much aligned with what I've been talking about for literally the last 10 years. They're saying that this is once in a generation, the worst situation in 50 years. This is a paradigm shift, not only in the monetary system itself, but in asset class valuations, asset class rotation, stagflation, global debt crisis, etc. They just released this a week or so ago. I thought this would be more apt than showing you global debt structures, because you guys are all aware of it anyway. If you look on the bottom right, US corporates, highly exposed to the rest of the world, these are the S&P forward earnings, which I would suggest they're all smoking drugs, to be honest with you. These markets are fully valued, particularly in American markets. This takes us into where we are today, which is what we've been concentrating on, or I particularly concentrate on, is a major global asset class rotation event. This is going back to 1885. Obviously, 1929, 1930, we all know what happened there. Now, this is against gold, the S&P against gold. But if you'd actually, I mean, obviously, gold was nationalised then. It went nationalised at 22, pushed up to 35. But wealth went into gold miners as a proxy to owning gold after they nationalised it. And gold miners went up anywhere between 600% to 800% during that period. But this obviously doesn't include the gold miners. This is just strictly gold. Leading into the Second World War, coming out of the Second World War, we went on a massive infrastructure spend out, demographic explosion. The stock markets performed, leading into obviously the 1970s. Stagflation. The US reneged on the monetary system at the time, and I'll get into that in a minute. Gold moved 22 times your money in this particular period, 12 years. This was 12 years. Oh, this was 12 years. Sorry, I'm seeing the screen on the side is confusing the crap out of me. Silver moved 44 times your money. We didn't have a debt crisis then. Volcker obviously rose interest rates to 19% and caused two major recessions, 1980 and 1982. But he got away with that because we didn't have a debt crisis. We moved into this period coming out. We had Thatcher, we had Reagan, we had the financialisation of the markets. Obviously we had a bonanza growth, and then obviously we had the dot-com bubble. That ended miserably, obviously. We broke again. Massive asset class rotation. Now, this was stymied, and the reason why this stymied, it should have fallen more realistic down here, is because they'd taken leverage to ludicrous levels. The whole Western banking system was going under on a knife edge, and they went to extreme interventionist policies. So that's where we find ourselves coming out of that, and hence we all were told to go and buy properties and stock markets, where we find ourselves today. The last couple of years, we all know that the valuations on stock markets, particularly the American stock markets, were ludicrous valuations, extreme. Ride the wave, of course, but be aware that valuation models just don't work anymore. We cracked in July 2024 against gold. And you've seen that momentum pick up, which leads us into this particular, which is my favourite slide, because I drew it. When I was still head of proprietary desk, I moved heavily into gold in 2002, 2003 because of Greenspan's policy actions, particularly with M3 and M4 coming out of the dot-com bubble. Pi cycles, forget about price. It's all about timing when it comes to pi cycles. And I need to understand how long this wave was going to be. So for me, I drew this wave cycle. Yes, I'd put Elliott wave over the top because it seemed to line up quite nicely with the waves. I only put Elliott wave because I showed clients a lot of waves, they get all confused. So it was easy to show an Elliott wave. But the cycles are very clear. This was 8.6 years. We broke a reverse head and shoulders and we moved from basically 265 all the way up to 1950 in 2011. Beautiful pi cycle. This was a 50% of pi, and it was also 50% in time frame. So we had a great indication that this was going to come to a low where gold was going to start moving higher again. And this was recognized if you overlay the macro with the fact that mines were losing money. The price of gold at that particular time, which is 1045, was lower than the cost of production. So it was easy to understand that we were getting to a low. It just aligned itself beautifully with pi again, with the cycles that I'd already overlaid. So like I say, I drew this out in 2005 just as a guide map, constantly overlaying the macro and chart technical analysis. But I haven't changed it. It's worked beautifully. Now this third wave higher, I released this in August and we got up to here exactly. July 2024. July 2024. It's uncanny how these pi cycles work. But understanding this third wave, knowing the fact that gold was going to be revalued in dollar terms, but it was underperforming here. The stock markets were outperforming gold. So this wasn't an asset class rotation. This was just basically a monetary debasement event. So that told me very clearly that this is not the money wave. This is the money wave. This is where you see your real bang for your buck. Again, it's an 8.6 year period. This aligns itself again with, oh, I'll go back again. Oh, I'll get onto the chart in a minute, sorry. This aligns again with the asset class rotation, global central banks buying, and obviously gold's been made a tier 1 asset class as of the 1st of July 2025, fully over a period into 2028. Gold is being remonetized. It's becoming hard tier 1 capital of all the banks in the West. This is physical, this is not derivatives. Part of the Basel III framework is it's physical. So the moves we've seen from literally the last 18 months of 1700 all the way up to 3,500. Think of a giant tsunami. The top 20% or top 15, 20% is global sovereign central banks. Wealth money hasn't moved. I mean, I speak to wealth managers all day long. They haven't moved. And the retail market haven't moved at all. When these guys move, which is 80% of the tsunami, that's when you start seeing your real bang for your buck. So going back here, this asset class rotation, these are very dramatic events. You ignore them at your peril. We've all seen this, global central banks. Now, obviously that's official net buying. Unofficial net buying is dramatically different. It's way higher. Obviously the Chinese are hiding their purchases, buying it through different conduits of the Chinese government and sovereign wealth funds, but also a great many central banks are not declaring how much gold they're buying. They've been buying net for 15 years. The last time we saw anything like this was in the 1960s, which was led by the French, until the US broke the Bretton Woods system, which led to 2,200% revaluation in gold. They're buying for a very, very real reason. We're heading to a giant monetary debasement event. So how fully valued is gold? Now gold, I've been reading the IMF and the BIS papers coming out, from the white papers that have been coming out for the last few years. They are looking to recreate the historical relationship to base money. So base money, average historical coverage across the world has been around about anywhere between 40 to 50% as a coverage ratio of base money. Now this is US. I downloaded from the US Federal Reserve total base money going all the way back to 1944 when the Bretton Woods system came into formation. Downloaded the gold reserve data and then downloaded historical gold price data, and you create this ratio chart. The reason why you fall here is obviously the bread and butters program, the Korean War, the Vietnam War, and the fact that they were losing the total amount of reserves. I mean, when they came out of the Second World War, they were enormously wealthy with gold because they stole it from the Japanese, who stole it from the rest of Asia. So they had a great deal sizable gold reserves, 72% coverage ratio. When it broke, it was 13%, near enough. And I did this chart 3030, and we're under 11. Now they want to put that historical ratio back into place. They want to move it towards 30 to 40%. They've already declared this. Now, if base money doesn't change, you're talking about $12,000 to $15,000 gold. Now, base money is obviously going to change. They're about to start the monetary engines again. Chinese are already doing it, obviously. And as we all know, Europe, US, etc., are in a terrible situation from a debt crisis standpoint. This chart basically tells you how undervalued gold is. If I used global base money, it's even more extreme. This is a very, very simple diagram of global capital flow. The bubbles in the middle are superfluous asset classes. These are your cryptos, your Van Goghs, your trophy homes, your Lamborghinis, whatever. They mean nothing in regards to global capital flow. These are your financialized assets. Property is in there because it's driven by debt. The vast majority of the time, property is driven by debt. Coming out of the GFC, global capital flow went in one direction, to an extreme nature that we've never seen before, which I'll demonstrate again in a second in the new chart. The real economy got starved of capex. And why would you? Why would you go and dig a mine or dig a wheat field when you can buy HDB in Singapore and make more money? Or buy Nvidia or Apple stock or whatever? Money went in one direction. Global capital flow went in one direction, driven by extreme central policies, which led us to global capex. 2015, that's 10 years in negative capex across all four commodity sectors. If you go back to 2010, it equals roughly 0% capex. But yet, global demand for commodities has expanded anywhere between 50 to 60%. I put a conservative number of 50, a lot of research agencies are saying 60%. The population of the planet didn't increase by 50, 60%. So this number is gigantic. And you can see this with obviously the China build out, Africa, emerging markets, and the insane Western government's decarbonisation of energy production. Nonsense they're all married to, which we can't ignore. It doesn't matter what we think about it, we can't ignore it. And this is something that, you know, Goldman Sachs commodity division's jumping up and down about. We've never seen anything like this before. So the six main drivers for precious metal revaluation. Deficits, which I'm going to get onto in a sec. Capex depression, which I've just demonstrated. Massive global capital imbalances, in valuation imbalances, and in capital flow imbalances. The global debt crisis, and it is a full-fledged crisis now. Macroeconomic headwinds. People are waking up now. And global capital has to flow to protect itself. It's wealth preservation. And also extreme undervaluations in the commodity sector and extreme opportunities there. And then obviously the super cycle and the full turning. Again, you've all seen this chart before. This is demonstrated again how ludicrously undervalued the commodity sector is. If you look at these metrics, take a straight line across, we've never seen it this cheap before. The platinum market. The platinum market now is in full crisis. American Anglo Platinum's pulled out the PGM market. They've already announced this 6 months ago. They're trying to sell their assets so they can pull out it completely. They've already told their shareholders because there was a shareholder rout, as you probably guys remember. And Anglo American Platinum is the largest single PGM producer by a country mile on planet Earth. They've had enough. We downloaded UN Comtrade data, which tracks all commodities in all forms to try and recognise where the metals were going. China is accumulating like crazy. These are physical deficits now. And every single research agency on the planet are pointing to the same thing. Supply-demand, industrial supply-demand imbalances or deficits as far as the eye can see. The platinum-gold ratio, this is the cheapest this ratio has been since the year 1885. You've got extreme valuations that don't make any sense anymore. The silver.
Minus platinum for what it's used.
Sorry? Oh, jewellery is a tiny little percentage. Catalytics, pollution controls, fibre optics, glass production, medical.
Okay, so cars is the big thing. So EV.
Cars.
No, EV.
It's particularly light commercial cars, diesel, light diesel. That's the biggest one. 45% of the platinum goes to that.
Okay.
And then probably another 30% goes on fibre optics and industrial.
Okay.
Consumption. So jewellery actually is shrinking part. Jewellery is probably as low as 20% or even lower now. So jewellery's been, and then we've got the few investors who have been bailing out. So in fact, the reason the deficit hasn't bitten so much now is that people have been selling back into the market.
So platinum is like an industrial metal? Or?
It is, yeah.
It's also, it's got a precious metal classification. That's because the investing community gets involved.
It's 20 times rarer than gold.
So gold, all the gold dug out of the ground, they've equated that it could fill 3 Olympic swimming pools. All the platinum dug out of the ground since the start of industrial humans would be up to your ankles in a single swimming pool. It's extremely rare. And it's very valuable as an industrial metal.
Very rare properties because it is the second hardest metal and it's got a high melting point. Hence it's used in the catalytic converters where heat doesn't matter, mechanical wear of gases passing over don't wear it out so quickly. That's why it's used in the fibre optic industry because the dyes for drawing the fibre optics are made from platinum so they don't deform or wear away.
And which country has the most platinum?
72% South Africa, 8 to 9% Zimbabwe. Russia was up to 11%. It's dropped down because of sanctions and lack of equipment going in, but it's about 6-7%. So between the three of them, they produce 92% of the world's platinum. And it's not as if they haven't looked elsewhere. South Africa is in full crisis. It's in an energy crisis, obviously. We can buy platinum today cheaper than we can dig it out of the ground. It's in full crisis. There was the latest report a couple of weeks ago from Heraeus that, they're wholesale closing mine shafts down. Now, the reason why they've kept them open is because they employ so much black townships. Putting them under is very bad politics for the South African government. But these guys are burning cash like it's going out of fashion at negative returns. So they're in full crisis.
But then if there's so much demand in industries, where's the imbalance here?
Well, you've got industrial demand that completely overpowers any supply. So you've got significant supply-demand deficit. Now that deficit has to be filled by something. Right. It's filled by above-ground liquid pools that floats around the world. Doesn't literally float, but it moves. If you have a long period of supply-demand deficit, those pools get decimated. The Chinese are trying to grab everything they can get their hands on because they're looking at 20, 30-year plans. Also, platinum is essential in the hydrogen industry. the production of green hydrogen and the conversion of hydrogen into electrical energy. It's platinum and iridium. So it's extremely important. Now, as we all know, markets tend to overextend for very long periods of time and stay undervalued for extreme amounts of time, ignoring supply-demand pictures. And we've experienced this with, we'll talk about that later, where we've taken advantage of that and made 15 times our clients' money in certain areas of these metals. They move. They make Bitcoin look silly. When they move, they go massive. So,
do global central banks, besides gold, own other precious metals?
Yes, I mean, Tony's here. Tony, we've flown over from, I'll quickly introduce, we've flown over from London. Tony's very experienced. What he doesn't know about precious metals is not worth knowing. He's an ex-chief dealer bullion in the bullion banks, and also run a refinery and several very high-profile trading outfits. So, as Tony says, there are central banks around the world that hold platinum, and they do switch from gold into platinum. You're taking views on extreme anomalies. For us, for myself, how do you lose money on platinum? It's in a supply-demand deficit. There's only 3 countries that produce it, and those 3 countries are in crisis. You're buying it today cheaper than they can dig it out of the ground. How on earth can you lose money on this trade? It's ludicrous. And when the tyre hits the tarmac, price revaluation is going to be extreme. So we've spent a lot of time measuring what the platinum price has to be to force a rebalance of that supply-demand picture. And it's quite dramatic. So silver. Silver's interesting. The blue ones are industrial supply and demand. So these are the net numbers. They do include coin sales, but as of this year, this big blue column here, coin sales were negative 28%. That's completely unsustainable. When they turn positive, that deficit's going to grow very dramatically. The red ones, if you include ETP demand. So silver is in supply-demand deficit. There is no arguing against that, and it's getting tighter. We've seen this with the lease rates. The backwardation curves on platinum is extreme now, and silver has been very extreme and still very highly elevated. This is telling you that tightness is coming into the market in extreme ways. And when you're commodities and you trade commodities and you see backwardation curves, and then you look at the supply-demand pictures, you know that there is a big move coming. It's unavoidable. It's mathematically unavoidable. Unless, of course, you don't believe in gravity anymore and Mother Nature. Again, I've inverted it this time, the gold divided by the S&P, and when it breaks these big asset class rotation events, you see big moves. This is silver. This is the gold-silver ratio.
Can I have the deck?
Yeah, I'll send you the deck. The gold-silver ratio. Now, you can take important data from the gold-silver ratio, believe it or not. To give you an idea, industrially, what they're digging out of the ground, the ratio is 7 to 1. For every 1 ounce of gold, it's 7 ounces of silver that's dug out of the ground. Ore grade on the planet is around about 12 to 14 to 1. So as you can see, these ratio analysis. Now, some people say, oh, well, yeah, it's a price ratio. It doesn't mean any different. Well, if you look at the copper-gold ratio, it stays very, very close to equilibrium to what global production is. I know because I've studied it. So silver is on steroids. Now, it's understandable, when the Second World War, we got up to 100. As the German tanks come over the hill, you're not going to be picking up your silver and running, you're going to be picking up your gold and running. So silver as a monetary item became extreme. But the reaction back down, it got down to 15 to 1. Iraq invades Kuwait, obviously oil went nuts, gold went up, obviously, because we thought we were going into a global recession on the back of the war. Then you had an extreme event, pushing back, silver back down. Hello.
Come and have a seat.
Again, we had the extreme again in the 2020 COVID crash. Silver went extreme, and we've got it again now. This is the fourth time in 100 years that the gold-silver ratio has gone above 100 to 1. So this is telling you that, one, it's an opportunity, an extreme opportunity. I'm not saying we're going back to the 1970s. We are definitely going into stagflation. We are definitely going into a monetary debasement. That's unavoidable. These are the asset classes that performed well during the 70s. Property got destroyed in the 70s, as we all know. In real terms and in nominal terms, it got killed. The stock markets didn't do very well at all for a very long period of time. This is about a major global asset class rotation. Avoid it at your peril. And this is the money wave, by the way, as I pointed out on the pi cycles and the ratio charts. So I'm going to leave it there. I'm going to bring Justin in.